Hey guys, welcome to TIP program. Today we'll be going through companies. Who are they? Why are they? What are they? And how are they? As you will soon learn that a company is its own person. Now, which is very distinct from what we've learned of sole traders and partnerships, where the sole trader is the owner of the business and actually is the person who's in the front line trading. Whereas the partners are also a partnership is a form of business enterprise, whereas you have two or more people coming together and forming a partnership agreement and have a stake in the business depending on the capital contribution and other factors as well, and run the business. Now, a company, however, is very different because a company has its own personality. It is regarded as its own person in the eyes of the law and can enter into contracts in its own names, which means that it can be sued and it can sue other people as well. A company can sue you as a person and will be regarded as a person in the face of the law. However, if a company now can actually be regarded as a person and do this, it cannot literally represent an entire corporation in court or entire corporation there during a merger of or a signing of a business deal. It will not be there. However, it has certain people, certain stakeholders that push its agenda for profit or other other things that could be on the agenda. Now, it does this through the form of what we call directors and other stakeholders. Now, the directors and other stakeholders will be the ones pushing the company's agenda and are there to actually facilitate the exercising of its legal personalities and can be seen as the eyes, the ears, the arms, and the brain of the company. And now, an important thing is that they do not enter into these contracts in their own personal capacities, but act in behalf of the company. Now, this comes together in the definition of a company as stipulated in the Companies Act number 71 of 2008, which defines a company as a form of business enterprise that is created by an association of persons with a common profit motive as a separate legal entity with its own legal personality under an enabling act of parliament. Now, understanding that and its definition, we know that, or we will soon learn that it has contract, as one would say, or a legal agreement, such as partners have their partnership agreement. For companies, it is called the Memorandum of Incorporation, MOI, which is a document that is required to form a company. And this document sets out the basic rules of how the company is to be run. And this document basically sets out the rights and duties of all the company stakeholders. So now you'd ask yourself, so we know who owns the sole trader. It is the sole trader, and we know who owns the partnership. And you come to and it begs the question: who owns the company? Now, the company is owned by who we call shareholders, and these shareholders contribute equity in a form of capital, but do not necessarily operate the business. However, what they do is they would most likely start a business and then make it a company and then employ directors who actually are the ones who are operating the business, which is now the company. And you'd ask yourself, who are these directors? These type of directors are what we call executive directors, which will be the focus, which kind of in a sense simplifies it in the context of where we are now, that these are what we call executive directors, which namely are the chief executive officer, your chief operating officer, and your chief financial officer. Now, this is a very niche goal of your chartered accountants and your finance bros to become the chief financial officer. Yes. Now that we know that, we will then delve into types of companies, because you don't have one type of company under the same umbrella, which you now learn is that we have two types of companies, namely your public company and your private company. Now, your public company has LTD at the end of its name, and your private company has what we call PTY Ltd, which is proprietary limited. Now, companies, as you will remember, are regarded as its own person. Now, we will introduce a concept named limited liability, which, because a company has a separate legal personality distinct from its owners, the shareholders cannot be held liable for its debt. Now, in the event of insolvency, the shareholders cannot be asked to settle the amounts owed by the company, because the company is its own thing and its own person. It's a grown-up, eh? It should be able to deal with its own problems. Now, the shareholders will each have contributed a certain amount of capital, and in the event of insolvency, this is the only amount that will be lost to them. So now, if a certain company B goes bankrupt and files for insolvency and is no longer, and it's demolished in a sense, you will not be paying its debt, but you will only lose the amount that you contributed to the company in the buying of your shares. That is the only loss you will incur. Now, the key differences between your public company and your private company are that your public company must have at least 3 directors in order to form a public company. However, your private company should at least have only 1 director. Now, your public company, which is a very key fact, is that it invites the public to buy shares by the means of a prospectus. Whereas in a private company, it is very difficult for a normal average citizen to buy shares of a private company. Now, they have their own processes that they follow, but in a public company, shares may be freely transferred through, as long as the public company is listed on the JSE. Now, the JSE is the Johannesburg Stock Exchange, which as if you've seen in the movies, there is what we call the New York Stock Exchange, where you'd hear people refer to it as Wall Street. That is where stocks are exchanged that are listed on the NYE, the New York Stock Exchange, the NCE. Now, transferability of shares is restricted in the private company. Now, other key factor is that financial statements must be prepared and published by public companies. Now, a public company cannot just prepare its financial statement; it is also liable to publishing them for the public to review. And the financial statements of a private company may be prepared but need not be published unless the private company has a high public interest score and thus must be audited. The financial statements must be audited of a public company by an independent auditor, which must be appointed by the audit committee and must be elected to each general meeting of shareholders, the AGM. Now, that sums up what companies are in an umbrella way. We will go deeper into what companies are in future videos. Cheerio, as we get closer to our last push. That's the end, guys.